Every empire borrows against time itself. Japan borrowed more than most, and it never stopped. In 1989, the Japanese economy was the envy of the world. Tokyo real estate was worth more than all of California. Then the bubble burst. The Nikkei lost half its value in 2 years. Real estate collapsed by 60%. Banks held trillions in bad loans. Corporations couldn't pay. The entire system froze. Most nations would have let the banks fail. Japan chose differently. It refused to let anything die. The government stepped in. It guaranteed deposits. It bought assets. It injected liquidity. It dropped interest rates to zero. Then below zero, it printed money to buy its own debt. The central bank became the largest holder of Japanese bonds, not as strategy, as necessity. Debt to GDP crossed 100%, then 150, then to 100. Today it sits above to 160%, the highest in the developed world. No crisis emerged, no default, no panic. Japan simply stopped growing. 3 decades passed. Wages stagnated. Deflation became normal. Young people stopped spending. The population aged faster than any nation in history. More retirees than workers. More debt than output. The economy didn't collapse. It just stopped moving forward. This is not a Japanese phenomenon. It's a pattern. That confidence was the first crack. Rome understood debt before economics had a name. The Republic ran on taxes and tribute, but the empire ran on promises. Soldiers were paid in future land. Grain was distributed on future harvests. Infrastructure was built on future wealth. For centuries, it worked. Conquest brought gold. Gold backed the currency. The denarius held value because Rome held the world. But conquest has limits. By the 2nd century, expansion slowed. New provinces cost more to defend than they generated. The army grew. The bureaucracy swelled. Costs rose. Revenue didn't. Emperor after emperor debased the currency. Silver content in the denarius dropped from 90% to 5%. Coins were remelted and reissued. Inflation followed, not gradually, exponentially. By the 3rd century, the economy operated on barter. Soldiers were paid in goods. Taxes were collected in grain. Money lost meaning. The empire didn't fall to invaders first. It fell to insolvency. The barbarians only occupied what was already hollow. Debt doesn't destroy nations quickly. It erodes them slowly until they can't respond to shocks. Florence learned this in the 14th century. The Florentine banks were the most sophisticated in Europe. They lent to kings. They financed wars. They underwrote trade across the Mediterranean. The Bardi and Peruzzi families were more powerful than most monarchs. Their largest debtor was England. Edward III borrowed heavily to fight France. The 100 Years' War was expensive. Edward kept borrowing. The banks kept lending. In 1345, Edward defaulted. The Bardi collapsed. The Peruzzi followed. Credit across Europe vanished overnight. Trade routes froze. Florence entered a depression that lasted decades. The families never recovered. The banks had believed sovereign debt was safe. It wasn't. It was simply backed by the illusion of perpetual rule. The same mistake repeated in Spain. By the 16th century, Spain controlled the richest empire on earth. Gold and silver poured in from the Americas. Philip II spent it faster than it arrived. He financed wars in the Netherlands, in France, against the Ottomans. He borrowed from German and Italian bankers at high interest. The gold wasn't wealth. It was collateral for debt. Spain defaulted in 1557, then again in 1560, and 1575, and 1596, and 1607. For times in 50 years, each default wiped out creditors. Each recovery required more borrowing at higher rates. Spain never reformed. It simply repeated. By the 17th century, Spain was irrelevant. The gold was gone. The debt remained. Empires collapse when debt exceeds the capacity to service it. The process is invisible until it's irreversible. No one noticed the collapse had already started. Weimar Germany is remembered for hyperinflation. Wheelbarrows of cash for bread, the collapse of the mark, the rise of extremism. But the hyperinflation wasn't the cause, it was the consequence. Germany lost World War I. The Treaty of Versailles imposed reparations, 132 billion gold marks, an impossible sum. The economy couldn't generate it, the government couldn't tax it, so it printed. At first, inflation was manageable, prices rose, wages followed, the economy adapted, then it accelerated. The mark lost value daily, then hourly. Workers were paid twice a day so they could spend before prices doubled. Savings evaporated. Pensions became worthless. The middle class was destroyed. By 1923, $1 bought for 0.2 trillion marks. The hyperinflation ended when the government introduced a new currency, the Rentenmark. Backed by land and industrial assets, trust returned. Stability followed. But the damage was done. An entire generation learned that money was a lie, that savings were theft, that only hard assets mattered. That distrust shaped what came next. The 2008 financial crisis began the same way. Not with printing, with borrowing. American banks lent against housing. Housing prices only went up. Mortgages were bundled into securities. Securities were rated AAA. Pension funds bought them. Insurance companies bought them. Central banks bought them. The collateral was fiction. When housing prices fell, the securities collapsed. Lehman Brothers failed. AIG needed bailout. Credit markets froze. The global economy seized. Governments responded like Japan. They guaranteed deposits. They bought assets. They dropped rates to zero. They printed trillions. But they didn't let the system reset. They preserved it. US debt doubled from 10 trillion to 20 trillion in a decade. Europe followed. China followed. Debt became the foundation of growth. Zero interest rates became permanent. Central banks became the largest buyers of government bonds. Markets stopped pricing risk. Everything inflated. Stocks, real estate, commodities. The recovery was real. The debt was deferred. Japan had pioneered the model 30 years earlier. The world adopted it in 2008 and never stopped. This is not a crisis, it's a system. Japan's debt to GDP is 260%. The United States is at 125. Europe averages 90. China's local government debt exceeds official figures. Exact numbers are hidden. Every developed economy operates on the same mechanism. Growth is funded by borrowing. Borrowing is funded by central banks. Central banks are funded by printing. The difference is time. Japan started first. It has traveled furthest down the path. What Japan reveals is not collapse, it's stagnation. For 30 years, Japan has maintained services, infrastructure, pensions, health care. Society functions. No riots. No revolutions. Quality of life remains high, but growth stopped. Wages flatlined. Innovation slowed. Young people stopped believing in progress. Consumption fell. Savings rose, not because people saved more, because they expected less. Japan chose stability over dynamism. It preserved what existed rather than allow creative destruction. Banks didn't fail. Corporations didn't restructure. Jobs were protected. Pensions were paid. The cost was the future. Debt doesn't demand repayment immediately. It demands growth forever. When growth stops, debt becomes eternal. It can't be inflated away without destroying savers. It can't be defaulted on without destroying trust. It can only be rolled over indefinitely. Japan has shown this is possible for decades, maybe longer. But possible is not the same as sustainable. Lebanon offered a preview of what happens when smaller economies try the same model. In 2019, Lebanon's banking system collapsed, not because of war, because of debt. The Lebanese pound was pegged to the dollar. Banks offered high interest rates to attract deposits. Those deposits funded government spending. Government spending exceeded revenue. The gap was covered by borrowing. The system required constant inflows. When capital stopped entering, the peg broke. The pound lost 90% of its value. Banks froze accounts. ATMs stopped dispensing. Savings vanished. Lebanon had no central bank powerful enough to print its way out. No reserve currency. No global. Creditors willing to roll over debt indefinitely. The collapse was total. The society still functions. Barely. Lebanon is not an outlier. It's a warning. Small economies can't sustain infinite debt. They lack the currency strength. They lack the institutional trust. When debt becomes unsustainable, they collapse quickly. Large economies have more time. Japan has the yen. Europe has the euro. The United States has the dollar. China has capital controls. These currencies buy time. They don't eliminate the problem. Japan's elderly population is the largest in the world. Over 30% are 65 or older. Pensions and health care are paid by borrowing. Tax revenue can't cover it. The working population shrinks every year.